Hey everyone, this is an article from Martha Campbell titled "The Credit System." It's about it's from a collection titled "The Culmination of Capital," which is essays on Volume 3 of Marx's Capital. So here we go. In describing the objective of Part 5 of Capital, Volume 3, Marx states that he is considering the credit system only to the extent, quote, necessary to characterize the capitalist mode of production in general, end quote. Marx. As this indicates, the credit system is, in Marx's view, so essential that no presentation of capital will be complete without it. It points also to a distinctive feature of Marx's account, namely, that he derives the credit system from capital, which Marx initially presents as industrial capital by itself. That is, Marx appeals to the requirements and inherent tendencies of industrial capital to explain why the credit system evolves. Footnote: this isolation of industrial from commercial and interest-bearing capital is not meant to be historically realistic. Marx emphasizes that the two other forms precede industrial capital. Industrial capital is the, quote, basic form within capitalism, since when capitalism encompasses production, capitalism encompasses all economic activity. End footnote. Starting from industrial capital, however, poses a problem for Marx. To show that capital creates the credit system requires an understanding of what capital is and how capital operates. But capital, being what capital is, cannot be conceived at all without money. But capital, being what capital is, cannot be conceived at all without money. Marx handles this problem by starting with commodity money, giving rise to much criticism and bafflement. If, as will be argued here, Marx demonstrates that capital creates the credit system, then Marx never meant to leave money as commodity money. That is, to suggest that capitalism operates with commodity money. This is simply the form of money capital does not create, but inherits from previous society. Since according to Marx, any form of money is a universal equivalent. Characteristics of the universal equivalent identified in Capital Volume 1 are preserved in bank money. In particular, the indirectly social character of capitalist production and the objectivity of value, which results from the indirectly social character of capitalist production, figure prominently in Marx's argument in Capital Volume 3. One consequence of this argument is that bank money emerges as the form of money specific to capitalism, replacing the troublesome commodity money of Volume 1. The first section of this chapter examines the reason Marx gives to explain why capitalism produces the credit system. The second section considers the effects of the credit system on the functioning of capital, chief among which are its collapse or financial crises. Since Marx refers again to metallic money in connection with crises, the third section examines what Marx means by the collapse of the credit system. Section 1. The evolution of the credit system. In Capital Volume 1, before Marx takes the credit system into account, Marx treats money as given by the original accumulation. Footnote. Both the supply and the form of money are given. End footnote. Together with the other prerequisites for production, it is presented as the property of capitalists. It constitutes the fund capital needs to begin capital's circuit. When Marx returns to money in Capital Volume 3, Marx revises this first account. Here the credit system, consisting of the banking system and the bond and stock markets, takes the place of the original accumulation. It supplies all forms of capital, including capitals within the credit system itself, or interest-bearing capital, with advances of money and of money capital. Marx supplies the basis for this switch between his Volume 1 and Volume 3 accounts by his argument that the credit system evolves of the credit system's own accord within capitalism, because the credit system, removes barriers to the expansion of capital. This section considers the reasons Marx gives for its evolution. Marx presents two complementary lines of argument to explain why the credit system develops. Along one, Marx argues that the banking system develops to overcome the limits of trade or commercial credit. This type of credit arises when one capitalist sells commodities to another in exchange for a bill of exchange, a promise to pay by a certain date rather than for money. Trade credit can be extended beyond two capitalists to the group of capitalists that is linked by regular transactions, because the different individual capitalists in it carry out different stages of the circuit of one product. Within such a group, the bill arising in one transaction can, in turn, be used by the creditor to buy on credit. Footnote: for example, A buys on credit from B, issuing a bill to B. B, in turn, uses A's bill to buy on credit from C. C completes the circle by using the bill to buy from A, which cancels out A's debt. Each accepts the bill because they know they can use it as a means of purchase. End footnote. Marx includes the development of clearinghouses for bills within the limits of trade credit. Clearinghouses enhance the circulation of bills because clearinghouses allow reciprocal debts to cancel each other out. Wikipedia says, a clearinghouse is a financial institution formed to facilitate the exchange, i.e. clearance of payments, securities, or derivatives transactions. The clearinghouse stands between two clearing firms, also known as member firms or participants. The clearinghouse's purpose is to reduce the risk of a member firm failing to honor its trade settlement obligations. A clearinghouse provides emergency lending and assists banks when they need help. End footnote. End Wikipedia article, back to the text. The reason to replace money with credit is that this reduces both the total capital and the amount of capital in money, i.e. idle form, that each capitalist needs in order to function. Commercial credit, however, can only replace money to a limited extent. Capitalists must still use money in transactions with non-capitalists, principally workers, but also the state. Footnote: Marx is well aware that capitalists must use money to buy wage labor. Marx regards this as one of many reasons why capital needs money. He presents these reasons in Capital Volume 2. Hence, he does not attribute the development of the credit system, therefore money's form as bank money, to the fact that wages must be paid in money. End footnote. Capitalists also cannot use credit whenever the seller's commodity belongs to a different nexus of transactions than the buyer's. The seller cannot use the buyer's bill as a means of purchase and so will not accept it. The most important limitation, however, is that with commercial credit by itself, capitalists are dependent on the timing of sales and must hold money reserves to meet their debts in case sales returns are delayed. According to Marx, the banking system represents an advance over commercial credit because the banking system eliminates this last reason for holding money. The distinction characteristic of the banking system is that the banking system concentrates the total money reserves in society into one pool for use by all individual capitals. This, quote, socialization of money for capital is the hallmark of the credit system because this, quote, socialization of money for capital is missing from commercial credit. Commercial credit, as de Brunhoff says, I think it's Susan de Brunhoff, says, quote, is on the borderline between the monetary and credit system, end quote. Banks lend from this fund by issuing their own promises to pay, either as banknotes or as bank deposits, and these are credit money. Footnote. Marx describes banknotes. So there's two footnotes here. Footnote 1. Wait, hold on. As de Brunhoff says, quote, I gotta restart some shit. This, quote, socialization of money for capital is the hallmark of the credit system because this, quote, socialization of money is missing from commercial credit. Commercial credit, as de Brunhoff says, quote, is on the borderline between the monetary and the credit system, end quote. Footnote. Commercial credit, unlike the elements of the credit system proper, is always connected to the reproduction of real capital. As a result, commercial credit serves methodologically as an anchor, a way of making visible the ties between real reproduction and credit, when these become more tenuous in the credit system. End footnote. Banks lend from this fund by issuing these banks' own promises to pay, either as banknotes or as bank deposits, and these are credit money. Footnote. Marx describes banknotes as, quote, credit money proper, end quote, and notes of the central banks as, quote, more or less legal tender, end quote. Unlike bills of exchange, which are due to be paid at a definite time, bank debt is, quote, payable at any time, end quote, meaning on demand. Hence, this is at least one of the key differences between credit and money. End footnote. The existence of banks allows commercial credit to be transformed into credit money by the practice of discounting. Discounting is the purchase by a bank of bills of exchange with banknotes. Since bank debt, unlike bills, does not have a payment due date, discounting is an advance of money. Footnote. The discounting of bills is simply a short-term bank loan. The reason to pose the argument as Marx does, in terms of the discounting of bills, is that this reveals the connection between commercial credit and bank credit. End footnote. Once non-financial capitalists can have bills discounted, they can accept bills from a wider range of other capitalists and are freed from the necessity of holding money reserves against delays in sales returns. Marx's second line of explanation is that the credit system develops from the hoards required for the circulation of capital. With the concentration of all hoards in the banking system, banks become the, quote, general managers of money capital, end quote, in charge of the system of payment and of lending. This is the, quote, socialization of money for capital, which evolves because of the advantages this, quote, socialization of money for capital entails for capital. The amount of money required to support any given level of economic activity is reduced, not only because all capitalists share the hoard, but also because banks need to hold as money only the fraction of their debts that the banks are, on average, asked to redeem. Footnote. In modern terms, this is the money multiplier, meaning that bank deposits are a multiple of bank reserves. Wikipedia says, in monetary economics, the money multiplier is the ratio of the money supply to the monetary base, i.e., central bank money. If the money multiplier is stable, it implies that the central bank can control the money supply by determining the monetary base. In some simplified expositions, the monetary multiplier is presented as simply the reciprocal of the reverse ratio, if any required by the central bank. More generally, the multiplier will depend on the preferences of households, the legal regulation and the business policies of commercial banks, factors which the central bank can influence but not control completely. Because the money multiplier theory offers a potential explanation of the ways in which the central bank can control the total money supply, it is relevant when considering monetary policy strategies that target the money supply. Historically, some central banks have tried to conduct monetary policy by targeting the money supply and the money supply's growth rate, particularly in the 1970s and 1980s. The results were not considered satisfactory, however, and starting in the early 1990s, most central banks abandoned trying to steer money growth in favor of targeting inflation directly, using changes in interest rates as the main instrument to influence economic activity. As controlling the size of the money supply has ceased being an important goal for central bank policy generally, the money multiplier parallelly has become less relevant as a tool to understand current monetary policy. It is still often used in introductory economic textbooks, however, as a simple shorthand description of the connections between central bank policies and the money supply. Back to the text. End footnote. The point of both lines of argument is that the credit system is the specific product of capitalism, because in numerous ways, the credit system overcomes barriers to the expansion of capital. Footnote. See also de Brunnhoff, 1998, who states that Marx presents the credit system as, quote, an institution peculiar to the capitalist mode of production, end quote. De Brunnhoff, end footnote. With the credit system, first, both money lending and the source of money become internal to the capitalist economy. Banks as intermediaries are links between capitalist lenders and capitalist borrowers, robbing, quote, usurers' capital of usurers' capital's monopoly, end quote. Marx. Footnote. Marx emphasizes the character of banks as intermediaries, in part because historically, this is the way commercial and industrial capital liberate themselves from independent usurers. Originally, this subordinates interest-bearing capital to industrial capital. In addition, it places all money reserves, even of non-capitalists such as landlords, at the service of capital. End footnote. Likewise, the creation of credit money by the banking system, quote, Likewise, the creation of credit money by the banking system restricts, quote, the monopoly of the precious metals, end quote. Marx. Second, the credit system liberates capital's expansion by reducing the quantity and cost of capital in money form. The substitution of credit between capitalists for money, functioning as means of circulation, is essential given that capitalism produces for sale and on a massive scale. Without credit, quote, the nation's capital, bracket, would have, end bracket, to double, so that commerce would purchase the entire national product with its own capital before selling it again, end quote. Marx, Capital, Volume 3. page 612. The availability of the banking system to individual capitalists emulates the need for the individual capitalists to hold reserves for the circulation of capital, the near monies that take the place of reserves, loans to banks and holdings of securities, collective surplus value. Fractional bank reserves mean that, quote, the reserve fund of the business community is reduced to a necessary minimum, end quote. Marx, Capital, Volume 3, 528. Further, the cost of capital of borrowing money is reduced since bankers lend at lower interest rates because bankers specialize in evaluating borrowers. Footnote: Marx quotes this point from a follower of Saint-Simon. Bankers lend at lower interest, quote, than the landlords and capitalists could do, as the landlords and capitalists could more easily be mistaken in the landlord and capitalist choice of borrower, end quote. Marx, Capital, Volume 3, page 741. End footnote. Third, the socialization of capital through the securities market and the banking system liberates capital's inherent impulse to expand from the limits of previously accumulated capital, allowing a, quote, tremendous expansion in the scale of production and enterprises that would be impossible for individual capitals, end quote. Marx, Capital, Volume 3, 567. Footnote. For this reason, Marx argues that, quote, the development of the credit system, necessarily runs parallel with the development of large-scale production, end quote. Capital, Volume 3, Capital, Volume 2, page 261. Also, that projects that require large startup outlays of capital, such as railways, can only be conducted on a capitalist basis because of the formation of joint stock companies, and prior to this can only be undertaken by governments. End footnote. Last, the credit system distributes capital over the economy as a whole, and in this way unifies all individual capitalists into one total social capital. It is therefore the means of equalizing the rate of profit on different capitals. This equalization, or the movement towards this equalization, is the law, quote, on which the whole of capitalist production depends, end quote. Capital, Volume 3, 566. In all the foregoing respects, the evolution of the credit system embodies the, quote, free development, end quote, of capital, positing, quote, capital's self in the forms adequate to capital, end quote. Marx. Marx, it should be noted, is not particularly interested in giving a full account of credit money. Marx specifically states this is beyond the scope of his plan. Capital, Volume 3, page 525. It seems likely that the integrating aspect of the credit system, referred to last, is the most significant point for Marx. As will be argued in the next section, the interconnection established by the credit system among all individual capitals is a precondition for crisis. New section, Section 2. Consequences of the credit system. While on the one hand, the credit system evolves because the credit system overcomes barriers to the expansion of capital, it also allows real capital to expand, at least temporarily, past barriers that are still in force. In addition, it takes off on its own, independently of the reproduction of real capital. On the other hand, because the credit system overcomes barriers by the socialization of capital. The credit system increases the interconnections among individual capitals, which increases the complexity of the capitalist economy. Socialization also reduces the total reserve, which increases the fragility of the system. These two characteristic features of the credit system taken together mean that when the delayed barriers assert their existence, the result is a crisis that is generalized to all capitals. Footnote. Thus Marx argues that, quote, the form of crisis belongs to periods with developed credit systems, end quote. Marx. Capital, Volume 3, page 682, end quote. This attributes crisis to the characteristics just listed that are introduced by the credit system. If the crisis were purely monetary, the crisis would occur with any form of money, including commodity money. End footnote. To elaborate the first point, the independence of the credit system is inherent in interest-bearing capital. As emerges most starkly from Marx's account of interest-bearing capital, apart from the institutional forms of the credit system. See chapters 21 to 24 of Capital Volume 3. The circuit of interest-bearing capital is completely external to the reproduction of real capital, meaning industrial and commercial capital. This separateness, in turn, is the reason for the doubling of claims that pervades all aspects of the credit system, i.e., one by real capital, or in fact by any borrower, the other associated with a financial asset or any lender. Footnote, as Marx states on page 601, quote, with the development of interest-bearing capital and the credit system, all capital seems to be, quote, all capital seems to be duplicated, end quote. End footnote. It is also the reason why the rate of interest is arbitrary. Since interest-bearing capital does not carry out any part of the reproduction of real capital, there is no value basis for the division between interest and profit of enterprise. Footnote. Sheffield, 1998, I think it's Bertram Sheffield, I'm not sure, proposes the interesting hypothesis that Marx treats the controversy over the 1844 Bank Act at such length to illustrate his case that there is no natural rate of interest, that the interest rate is instead determined by such accidental factors as banking legislation. This controversy also shows that society, as represented by government, is not controlling the economy, i.e., eliminating crises. End footnote. End footnote. Last, it is the reason why the credit system is the source of illusions. With commercial credit by itself, credit is given to a buyer only to accomplish the sale of commodities. If bills embody prices that ultimately cannot be realized, bills are inextricably tied to the circulation of real capital. When bills are discounted by the banking system, when bills join the credit system proper, however, they can become detached from the circuit of the real capital to which they correspond and appropriate other capital. This does not occur with the discount of a normal bill, which simply involves an advance of money. The bill corresponds to some intermediate stage of the value of commodities, which are in process towards their final form, and will be paid by the revenue from those commodities' final sale. By discounting the bill, the banker anticipates this final sale or, quote, pre-validates this final sale. In an expansion, normal bills may be discounted so that the reproduction of capital can speed up or proceed on a larger scale. By contrast, the discount of accommodation bills meaning bills that, quote, do not represent any real transactions, end quote, masquerade as an exchange of money now for money later, but involves an advance of money capital. Because the bill is fictitious or represents no real value, but the bill's seller receives value in money form from the bank when it is discounted. Footnote. Engels states that, quote, there can only be a capital advanced with the discount of a bill if the bill is an accommodation bill, end quote. Engels. Marx seems to be absolutely intrigued by accommodation bills and to revel in the accommodation bill's myriad forms. The range of accommodation bills these accommodation bills range from situations in which commodities are purchased just to discount the bills drawn against the commodity's final sale, to paying off a previous bill by issuing another, to duplication of bills on the same commodities. In essence, these are all forms of adding to an existing loan to prevent the bankruptcy of the borrower. End footnote. Since Marx regards banks as intermediaries, in his words, the seller of an accommodation bill, quote, gets his hands on other people's capital, end quote. Capital Volume 3, page 555. Because normal bills may turn into accommodation bills with a decline in prices or a halt in sales, normal bills and accommodation bills are often indistinguishable in practice. Footnote. Engels states that, quote, no banker will accept a bracket accommodation bill, end bracket, if that banker recognizes that accommodation bill for what that accommodation bill is, end quote. But Marx cites testimony of bankers indicating that bankers cannot tell whether a bill is, quote, drawn for produce or for wind, end quote. Capital Volume 3, page 541. Evaluating a bill's quality is made more difficult because bills are bought and sold by different kinds of intermediaries, e.g. bill brokers as well as banks. End footnote. Once an advance is made, it is unclear whether that advance was an advance of liquidity or of capital. That is, whether the advance is repaid by the sale of commodities corresponding to the bill, meaning that the sale just required extra time, or whether it is repaid out of the circuit of a new capital. The transformation of normal into accommodation bills is virtually inevitable. Since the transformation of normal into accommodation bills occurs on a regular basis at the end of economic expansions, credit, which in the expansion corresponds to an increase in the speed and scale of the circulation of real capital, turns into credit that merely allows production to continue past the time when final sales have slowed. Footnote, quote, markets are overstocked and the apparent prosperity is maintained only by credit, end quote. Marx, 1894, Capital Volume 3, 705, end footnote. In this way, the credit system allows industrial and commercial capital to outstrip realization, as de Brunhoff says, deferring, quote, the limits of money circulation, end quote. De Brunhoff. The impulse for expansion lies, quote, in the tremendous elasticity of the reproduction process, unquote. Marx, Capital Volume 3, page 419. Capital is by nature always ready to, quote, pursue the production process past the production process's capitalist barriers, end quote. Capital Volume 3, page 640. Since the scale of production is determined more by the quantity of capital and the need of the capitalist, quote, production process for continuity and extension, end quote. Marx. Capital Volume 2, page 221. By anticipating value realization, e.g. by pre-validating bills, the credit system gives capital's impulse to expand freer rein. The other credit system duplicates of real capital, such as bonds and stocks, are from the outset less connected to the circulation of their corresponding real capital than commercial credit. As interest-bearing capital, their circuit is external to that of real capital to begin with. They become further detached from real capital in a variety of ways. Most straightforwardly, their value is determined by capitalization, independently of the value of real capital, and varies with the interest rate in supply and demand. Detachment from real capital is carried further when financial assets are issued by parties other than commercial and industrial capitalists. Marx's statement that interest-bearing capital within capitalism is distinguished from usurer's capital before capitalism by the, quote, transformed figure of the borrower, end quote, as an industrialist or merchant is, in fact, an idealization. With capitalization, any regular revenue seems to arise from the capital value, which, quote, capital then seems to be the revenue's source. Because the credit system inverts shares into sources of surplus value, anyone with a regular revenue may borrow by issuing financial assets. Besides borrowing by real capital, interest-bearing capital may lend to itself. Landowners may obtain mortgages and governments issue securities. The final and most striking step in detachment is speculation in financial assets based on those financial assets' expected future price than on those financial assets' more distant connection to surplus value. Footnote, this is the form of detachment that Keynes laments. See Keynes, 1936, chapter 12. The second aspect, the increased complexity and fragility of the reproduction of capital, is introduced by commercial credit. This enhances fragility because it imposes a time constraint on the final sale of commodities. It adds to complexity because all capitals participating in the reproduction of one commodity are linked by the circulation of the same bill. All are therefore dependent on the sale of that commodity at its expected price. Failure to sell in the specified time or at the expected price leads to forced sales to meet debt commitments, and therefore to deflation. Footnote, if the commodity cannot be sold at the commodity's expected price, a, quote, whole series of transactions which retrogressively depend on this one transaction cannot be settled, end quote. Marx. I'm not sure where that quote's from. End footnote. The pressure to sell may be alleviated temporarily by discounting bills. Ultimately, however, the credit system reproduces these same characteristics on a larger scale. The range of interconnections among individual capitals is extended as, quote, advances among industrialists and merchants fuse, end quote, in the banking system. Credit money enters circulation through discounting bills. As Marx emphasizes, the circulation of credit money is determined by the circulation of bills, rather than by simple monetary circulation. This means that it involves the same interconnections as bills, that like bills it is associated with forced sales, and also that it functions as a means of payment rather than as means of purchase. Footnote, part of Marx's reason for emphasizing that the circulation of credit money banknotes, is based on the circulation of bills is that this makes the quantity theory completely absurd. By the time money as means of payment enters circulation, the commodities corresponding to that money have already left circulation. Hence, quote, the quantity of money in circulation no longer corresponds with the mass of commodities in circulation during a given period, end quote. Marx, Volume 3 of Capital 2, page 237. End footnote. Reliance on interest-bearing capital imposes narrower limits on the acceptable rate of gross profit, raising its lower limit to the rate of interest. Because the reserve of money is reduced to the minimum reserve required on average, it is insufficient for the exceptional circumstances that always arise. Footnote: this is the reserve that banks would hold of their own accord in the absence of legal regulations on reserves. End footnote. The really crucial aspect of fragility, however, is that all credit shares the same fate. When the collapse comes, good credit, that would have been socially validated, is devalued along with bad credit, issued in connection with speculation and fraud. Footnote: this is the reserve that banks would hold of their own accord in the absence of legal regulations on reserves. End footnote. The really crucial aspect of fragility, however, is that all credit shares the same fate. When the collapse comes, good credit, that would have been socially validated, is devalued along with bad credit, issued in connection with speculation and fraud. Did I already say that sentence? Sorry. Might have said that sentence already. Footnote: most bills represent actual purchases and sales, but on too large a scale. Added to these is speculation on borrowed capital and fraud. End footnote. Marx describes the crisis as an attempt to transform all credit into money. Money is only a fraction of credit. This transformation cannot be accomplished. Because individual capitals have replaced money reserves with bank deposits and securities, when they are unable to meet debt commitments, the commodity price deflation that would have occurred without the credit system is replaced by bank runs and securities market crashes. In summary, with the credit system, capitalism creates its own form of money. Capitalism's own more liberal method of financing capital's expansion. And with financial assets, a completely novel kind of asset, by its detachment from real capital, involves its own principle of pricing. The overextension of reproduction relative to final realization, together with increasing fragility, means that any restriction on credit, quote, acts as the feather which, added to the weight already on the scales, is enough to tip the balance, end quote. Marx, Capital, Volume 3, page 705. Footnote: this is overextension of both industrial and merchant capital, as well as speculation and debts associated with it. As Marx says, quote, too much trade, too much production, too much credit, end quote. Capital, Volume 3, 640. The restriction Marx refers to as the limit imposed by the 1844 Bank Act, which stipulates that the central bank can only create notes lent to private banks in accordance with its gold reserve. The crisis Marx discusses are all created by the central bank refusing to expand its note issue or loans. End footnote. Complexity ensures that all capitals are caught in the same net. All commodities and all financial assets have to prove their value by being transformed into money. This, quote, collapse of credit into the monetary system, end quote, as Marx calls it, involves the discredit of all credit, bank runs, and the devaluation of financial assets. Section 3. The collapse of the credit system. The credit system promotes the expansion of capital. But financial crises are evidence that the reproduction of capital is still subject to constraints. The assertion of these constraints is merely delayed by the operation of the credit system. As de Brunhoff says, quote, "The credit system defers limits of money circulation, but does not suppress the limits of money circulation," end quote. De Brunhoff, 1998, page 184. A problem arises in connection with Marx's account in Capital, Volume 3, regarding how far the collapse of the credit system proceeds. If the credit system is created by capital, as Marx maintains, then once the credit system is developed, the credit system should remain a permanent part of capitalism. In other words, the assertion in a crisis of the constraints on capital's reproduction should not abolish the credit system itself. Marx's references to gold money, however, could be taken to suggest precisely this, that the credit system is eliminated by the credit system's collapse, so that capitalism reverts back to the pre-capitalist form of money. To resolve this problem, this section examines what Marx means by the collapse of the credit system. Regarding the constraints on the reproduction of capital, 2 points should be noted. First, Marx discusses the credit system entirely within the context of the distribution of surplus value among capitals. The credit system introduces a new principle of profit and loss for individual capitals. As Marx observes, within the credit system, quote, "gambling, now appears in place of labor as the original source of capital ownership," end quote. Marx, Capital, Volume 3, page 609. The gambling Marx has in mind involves transactions in securities, that is, fictitious capital, by which winners, quote, "get their hands on other people's capital," end quote, or expropriate capital and surplus value from each other. While this really is a source of capital for individuals, both Marx's references to, quote, "other people's capital," end quote, and the context in which Marx discusses the credit system suggest that gambling cannot add to the total value of capital. By contrast, when Marx represents the exploitation of labor as the source of surplus value in Capital, Volume 1, the case Marx makes is that this is the only possible source of a net increase in surplus value for capital as a whole. Thus, the idea that gambling is a source of capital must be one of the illusions generated by the credit system. Footnote: the references to Chapter 5 of Capital, Volume 1 compare Gonsman's 1998 more ambiguous statement, quote, "in juxtaposing ... labor and the, quote, game of speculation as principal modes of appropriation, Marx himself indicates that it is necessary to step away from his value theory in order to analyze the realm of money as a symbol of self-expanding wealth," end quote. Gansman. End footnote. Second, the particular way the credit system defers constraints is that credit of all kinds, commercial, banking, the securities market, is based on expected prices, in Marx's terminology on ideal rather than realized value. Footnote: because the credit system operates on this principle, it can disguise disproportionalities and delay the manifestation of the reduction in surplus value that occurs with technical change. Thus, the credit system promotes expansion in the sense that the credit system allows expansion to proceed even though the conditions for the reproduction of capital are not met. End footnote. Lender and borrower share, quote, "confidence in the social character of production," end quote. And this confidence, quote, makes the money form of products appear as something evanescent and ideal, end quote. That is, as superfluous and a mere formality. It is a matter of, quote, confidence rather than objective evidence because the, quote, society of two, lender and borrower, cannot impose their evaluation on society at large. In other words, the credit system inherently operates on the pretense that indirectly social, private and independent production is directly social. Credit versus money merely repeats the opposition between private and social that obtains between value in commodity form, ideal value, and value in money form, realized value. Marx indicates early in Capital Volume 1 that this is the opposition that becomes plain in a crisis. Quote, the antithesis between commodities and the commodities' value form, money, end quote, appears as a, quote, absolute contradiction, end quote. Marx, Capital Volume 1, page 286. This opposition is fundamental to capitalism. Marx first presents it in terms of simple circulation, but it is preserved throughout as Marx develops the more complex aspects of capitalism. There's a footnote that I missed. It says, because the credit system operates on this principle, it can disguise disproportionalities and delay the manifestation of the reduction in surplus value that occurs with technical change. Thus, the credit system promotes expansion in the sense that the credit system allows expansion to proceed, even though the conditions for the production of capital are not met. End footnote. It is not overcome simply by the change in money's form from precarious metal to bank money. Hence, Marx adds that in a crisis, quote, the monetary famine remains whether payments have to be made in gold or in credit money, end quote. Footnote. This passage also indicates that Marx knows that money is credit money, and as Gonsman says, that, quote, Marx did not claim that gold is the money commodity, cannot be replaced by a, quote, representative, even in such an extreme situation, end quote. Gonsman, 1998. End footnote. Thus, one meaning of Marx's claim that the credit system is not, quote, emancipated from the monetary system, end quote, is that ideal values, provisionally validated by credit, must ultimately be realized. This is the original and most basic monetary constraint. It has nothing to do with the metallic form of money. While in Capital Volume 1, Marx suggests that credit money still functions as money in a crisis, so that at least this part of the credit system is preserved. In Capital Volume 3, Marx states that, quote, precious metal remains the foundation from which the credit system can never break free, end quote. Capital Volume 3, page 741. In part, statements to this effect refer to the regulations established by the Bank Act of 1844, which make the creation of central bank money conditional on a gold reserve. This regulation forces the central bank to cease acting as a lender of last resort whenever the gold reserve is reduced. Private banks, in turn, must refuse to discount bills because private banks would lack sufficient reserves to meet the private bank's own liabilities. Commercial credit is thereby detached from the banking system. The credit system is eliminated in the sense that credit reverts to commercial credit by itself, outside the credit system, i.e., with no access to the pool of funds the credit system creates. The restriction of loans by the central bank would have this same effect no matter what the central bank imposes, no matter why the central bank imposes the restriction. The quantity of gold just happens to occasion this restriction in the institutional framework established by the Bank Act. Footnote. For example, the same effect results when the central bank attempts to control inflation by refusing to accommodate demand for money. As Wolfson 1994 shows, the pursuit of this policy by the U.S. Federal Reserve from 1966 to 1979 produced a series of, quote, credit crunches, end quote. End footnote. Since for Marx, the definitive characteristic of the credit system is the creation of a pool of funds accessible to all capitalists, in part also the, quote, collapse of the credit system, end quote, just means the denial of access to the pool. Marx speaks of this as, quote, hoarding, but by this Marx means the refusal of banks to discount bills, that is, to lend. Footnote. See Marx. It's a bunch of pages from Volume 3. Marx also meant the sale of securities, principally by banks, but also by others, in order to meet liabilities. End footnote. Keynes's comment on hoarding is perfectly compatible with Marx's argument. As Keynes notes, since, quote, it is impossible for the actual amount of hoarding to change as a result of decisions on the part of the public, end quote. Keynes. Hoarding cannot mean, quote, the actual hoarding of cash, end quote. Keynes, 1936, page 174. Keynes therefore substitutes, quote, propensity to hoard, end quote, for, quote, hoarding. An increase in the propensity to hoard resulting in an increase in the rate of interest rather than an increase in the quantity of cash held. This same substitution can be made in Marx's account. It implies only that a spike in the rate of interest is one of the manifestations of hoarding. These meanings of the collapse of the credit system do not entail a reversion to gold money. Moreover, Marx knows that the tie between credit money and gold exists only because it is established by the Bank Act. It would be strange if Marx considered this tie to be necessary, since Marx regards the Bank Act as foolish. In opposition to the Bank Act, Marx argues that no tie between credit money and gold is necessary domestically. See Capital Volume 3, page 649 and 674. This leaves gold as world money. Footnote. Thus, as Gansman argues, reserves for international trade, quote, appear as the last anchor of an otherwise free-floating credit system, end quote. Gansman. This Gansman calls Marx's, quote, strong argument, but Gansman points out that Marx is entertaining alternatives to it. End footnote. Marx emphasizes, however, that capital transcends national boundaries. Since Marx argues that capital creates credit money as its own form of money, it would be inconsistent to maintain that it is necessarily tied to pre-capitalist money at the international level. Even if we suppose that Marx is deceived by the institutions of his day, however, his references to gold make a point that still applies to credit money. This is that capitalism is intrinsically uncontrollable. It is a system of production that is socially determined to the core, except in the respect that it is not subject to social control. For this reason, value, the social character of products, appears as an objective property of products. As Marx emphasizes, it appears to be the product's property, not ours. Value appears to be the product's property, not ours. The objectivity of value stems from the indirect social, in other words, simultaneously private and social, character of production. The entire significance of money as universal equivalent is that it mediates, allows the existence of this contradiction, but does not remove it. Money accomplishes this mediation by being the thing, external to the commodity, that stands for the commodity's social character or value. Since the same opposition between commodity and money is repeated in the opposition between credit and money, in discussing the credit system and the credit system's collapse, Marx speaks again of money as a, quote, thing. By this, Marx means not that money is gold, but that money is the social character of production, which must take the form of a thing because production is indirectly rather than directly social. That this is Marx's meaning is shown by Marx's constant association between money as a, quote, thing and the contradiction between private and social. Money is, quote, in actual fact nothing but a special expression of the social character of labor and labor's products, which, however, as antithetical to the basis of private production, must always present itself in the last instance as a thing, end quote. Marx, Capital Volume 3, page 742 to 743. Quote, this social existence that it, bracket, money or gold is money, end bracket, has, thus appears as something beyond, as a thing, object or commodity, outside and alongside the real elements of social wealth, end quote. Capital Volume 3, page 707. Quote, bracket, the collapse of the credit system, end bracket, shows strikingly by its effects that production is not really subjected to social control as social production, and that the social form of wealth exists alongside wealth itself as a thing. End quote. Marx, Capital Volume 3, 708. Footnote. Marx actually says, quote, a drain of gold, end quote, but Marx was referring to the institutional arrangements of the 1844 Bank Act, under which a drain of gold necessitates a reduction in lending by the central bank, which brings about a collapse of the credit system. To make his statement more general, I refer to this collapse. End footnote. Quote, as long as the social character of labor appears as the monetary existence of the commodity, and hence as a thing outside actual production, monetary crises, are unavoidable, end quote. Capital Volume 3, page 649. Footnote, that money is a thing, quote, outside actual production, end quote, or, quote, outside the real elements of wealth, end quote, shows that Marx is not speaking of money as a commodity. End footnote. It is methodologically simpler to express the objectivity of value in gold money because credit money and the bank regulations associated with it create the appearance of government control of the economy. Footnote. Alternatively, they create the appearance, emphasized by monetarists, that all crises are attributable to the government. End footnote. The Bank Act of 1844 is one attempt at monetary policy, intended both to regulate the value of money and to make, quote, crises, impossible once and for all, end quote. Engels in Marx in the preface to Capital Volume 3. Or, not the preface, I don't know what you call it. It's on page 688, it says. So that's towards the end of the book, right? That the Bank Act actually brings about and intensifies crises does not say much for social planning. The deliberations of Parliament, which Marx cites so extensively, do not inspire confidence either. From Marx's perspective, it is ridiculous to suppose that these, quote, experts, who have no idea what capital is, will devise a means of overcoming the crises inherent in capitalism. Footnote. In particular, they argue endlessly over whether capital is money or commodities, a point Marx addresses in Capital Volume 1, page 255. End footnote. Even if the central bank can learn to act so that the central bank is not itself the source of financial crises, the central bank does not have a free hand. The arbitrariness of the interest rate allows some leeway for institutional determination, but this only favors financial capital at the expense of industrial and commercial capital, or vice versa. The central bank cannot create value by increasing credit money. If the central bank's pre-validation of credit is not confirmed by value realization, the central bank only engages in pseudo-social validation, which benefits some factions of societies at others' expense. That is, it redistributes value. Footnote. See Reuten and Williams, 1989, and De Vrooy, 1984, who calls pseudo-social validation, quote, extra money. End footnote. In Marx's view, at least, as long as production, quote, decisions are left to the market, money, since money realizes value, is a thing by which social conflict among capitalists and between capitalists and workers is managed. In this sense, credit money is just as much a thing as gold money. New section, Section 4, Conclusion. This chapter is focused on Marx's case that capital creates the credit system. By Marx's account, the credit system emerges because the credit system allows capital to internalize money and finance and to overcome, as well as disregard, factors that would otherwise constrain expansion. As has been argued also, Marx's description of the collapse of the credit system does not imply the abolition of the credit system itself. Marx's references to gold are instead appeals to the objectivity of value. For these reasons, Marx's presentation of the credit system in Capital, Volume 3, should be taken as a revision of his presentation of money in Volume 1. It is one of the intentional revisions entailed by his method. In this instance, Marx needed the results established in both Volumes 1 and 2 to show why the credit system emerges from capital. Footnote. For a discussion of the aspects of the credit system that emerge in Capital, Volume 2, see Campbell, 1998. End footnote. On this interpretation, Marx not only recognizes that the modern form of money is bank money, but Marx shows why money in capitalism necessarily takes the bank money form. And that's the end of the piece. I'll read the bibliography. Riccardo Bellafiore, edited volume 1998, Marxian Economics, a reappraisal, volume 1. Susan de Brunhoff, 1998, Money, Interest, and Finance in Marx's Capital. Suzanne de Brunhoff, 1973, Marx on Money. Martha Campbell, 1998, Money in the Circulation of Capital, in C.J. Author's edited and Geert Reuten's edited volume, The Circulation of Capital, Essays on Volume 2 of Marx's Capital. Heiner Gansmann, 1998 article, The Emergence of Credit Money, in Bellafiore's 1998 volume. I'm going to look up who this Heiner Gansmann is. Heiner Gansmann was born in 1944 and died in 2018 and was a German sociologist. Gansmann studied sociology, philosophy, economics, and history at the Free University of Berlin from 1963 to 1969, and subsequently worked as a research assistant at the Institute of Sociology there until 1976. After a 3-year stay as an assistant professor at the New School for Social Research, he became a professor of sociology at the Free University of Berlin in 1980. He retired in 2009. As an author and editor, 1987 to 1999, he is associated with the journal Prokla. His academic work included the relationship between economics and sociology, as well as the topic of, quote, money and labor. In 2006, Gonsman was awarded the John G. Diefenbacher Prize. Back to the text. Keynes, 1936, The General Theory of Employment, Interest, and Money. Marx, The 3 Volumes of Capital, Theories of Surplus Value, Part 2, Grundrisse. Geert, Reuten, and Michael Williams, 1989, Value, Form, and the State, The Tendencies of Accumulation and the Determination of Economic Policy in Capitalist Society. Bertram Sheffield, 1998, The Relationship Between the Rate of Profit and the Rate of Interest, a reassessment after the publication of Marx's manuscript of the 3rd volume of Das Kapital in Bellafiore's 1998 volume. Michel de Vroy, 1984, Inflation, a Non-Monetarist Monetary Interpretation, published in Cambridge Journal of Economics. And Martin Wolfson, 1994, Financial Crises. In reference to Bertram Sheffield, the reason I know his name is because I have a video coming up. I don't know if it'll be out first, this one or that one, by Michael Heinrich, critiquing an entry from Bertram Sheffield in the Marx Engels Gesamtausgabe 2. But anyway, thanks for listening to that. I know that stuff is a little hard to get through, and I'm still learning it. I read this article a number of years ago, and it's hard for me. I find the Capital Volume 3 and those kind of, when people start talking about like credit and stuff like that, I don't know what's going on. But thanks for listening.